Hey, good morning, everyone. Marty Mazzora here, November 1st, 2019, Friday morning, about a half hour, 25 minutes or so before the market opens. So this is the S&P 500 futures chart that you have in front of you. Got a really good jobs number this morning that was just reported a half hour ago. The number was expected to come in notably below 100,000, a lot having to do with the GM strike, came in at 128,000, and they revised the last 2 months' numbers up substantially. So when you add in revisions, this month was good for about 199,000, I think it was, new jobs added. So that's a good number. No ifs, ands, or buts about it. Hourly wages were a little disappointing. They were up, but not up as much as expectations. Average work weeks were about the same. So there's really nothing. You can try to poke holes in this report, but I think you'd have to try pretty hard. Manufacturing jobs are still being lost, although again, we had the GM strike, so it wasn't nearly as bad. In fact, we may have had a net addition when you look at manufacturing jobs. Big increase in the services sector jobs and so on. So I'll give one to the pessimists, and I know I've been sounding somewhat pessimist about just general conditions of late. And that would just simply be that, employment numbers at best are coincident, meaning they're not leading indicators. A lot of people say that they are lagging indicators, and actually they're some of both when you break down the components. So what it says is it's basically what happened, this month or last month, and that's okay because the expectations for last month were not good. So the fact that the jobs number came in better says something good about the state of the economy. And again, it is a services economy, it is a consumption economy, so we do want to pay attention to the health of the consumer. Now, what I've been showing you now for multiple months is that the consumer continues to hold up quite nicely. But under the surface, industrial production, durable goods, the industrial data, manufacturing sentiment. Now, in about an hour, we're going to get the ISM manufacturing survey, and it's had 2 months of contraction. It's basically been signaling a recession for the industrial sector. Looking at the regional surveys as they've come in, it might surprise to the upside. I don't know that it'll get back to 50. Remains to be seen, although I must say the Chicago Purchasing Managers Index that came out yesterday was absolutely abysmal. So it was very ugly. So that put kind of a damper on expectations for the ISM. But we're getting, surprisingly good news. Overnight, China's industrial data was notably better than expected, and this was the private sector survey. It wasn't even the government number, which is always suspect to manipulation. So again, not bad. Surprisingly good. In fact, I'm surprised. Again, the monthly average is lower, but nothing there by itself that says we have anything to worry about. You got to dig a little deeper, which we do in our index, which I'll be scoring either this afternoon or tomorrow morning. And it's been in the red. So when we take all of the data out there that we think is important, there's still a great deal of economic risk in the system. I'll just say it one more time. Jobs number today is encouraging. Under the surface, however, and this is going to be more of the stuff on the written blog. In fact, my weekly message yesterday was anything but inspiring, and I cited two recent research reports, very recent, in fact, from Moody's, the bond rater, and from the International Monetary Fund. And what I focused on, which is what these reports focused on, and that is the state of debt throughout the world. The IMF really digs into sovereign debt as well as corporate debt and consumer debt and so forth. But on the corporate side, it is a very scary picture under the surface. So whether it's anytime soon or it's within the next the next couple of years, when we ultimately begin to contract as an economy, or I think when we start seeing a spike in interest rates and we get some of the widening of some of these cracks or fractures that I see below the surface, I do think the next disruption in the financial markets is going to have the odor of something along the lines of 2008. Of course, that bodes very poorly for the prospects for investors in equities and other things, going forward. So we have asset price valuations, no doubt, are extended. Bob Shiller, the Nobel Prize economist who gets a lot of credit for calling the last two bubbles, in an interview this week, he said he just sees bubbles everywhere, and he's not sure what people should do. We'll see. I do see a bubble in the credit markets. I even titled the weekly message yesterday to basically confess that that's how I see it. I see a market at all-time highs. I see valuation stretch, and I'm going to get into the technicals now. Our portfolios for clients are adequately hedged, I think, to compensate for what I think is huge under the surface risk. And I do have said, for weeks and weeks now, that we did expect a new high, and I think a marginal new high that ultimately doesn't get very far. My base case is that probabilities, despite today's jobs number, suggest that the next big move, the next big double-digit move, is more likely to be lower in the market as opposed to higher. We have our very definite upward sloping wedge. That's a bearish pattern. You can see we had similar patterns at all of these last four tops or so. And we also had divergences down in here in momentum. And you can see it's just kind of extended here, not as much on the RSI, but certainly on the MACD. So we just get a marginal new high. You can see this beginning to roll over. You can see it on the histogram. If that continues, it just confirms that there's some really serious downside risk in this market on these charts when we zoom out a bit. Doesn't have to play out that way. We get good news on the trade war and so on and so forth, and continuing good news on the economy. And there is a scenario, in theory, that when conditions on the surface, when I climb up on my lookout tower and if those dark clouds that I see out there really begin to dissipate, then we won't need to hedge like we are. But right now, folks, I'm not seeing nearly enough yet that would have us, suddenly give up on our defensive posture. But again, we'll see how the data continues to play out. Okay, so let's focus then on these technicals. Let me zoom out just a bit. And again, what have we been getting from January 2018 at this all-time high? It's just these little small moves to marginal new high territory. Up until yesterday, the move from here to here, which is about 2 years, is just a 6% move in the S&P 500. So that's just not much of a move for the stock market when we're supposedly in this great bull market, over the last couple of years. And what's gone along with that are these concerning divergences. You can see the look that led up to that big virtually 20% correction this last year. We came out of here, we had a really nice look in here, and we were optimistic, and then things began to roll over, and pretty much from this point forward we began sounding a pretty concerning tune. And it was right up in here when we began recommending that we to clients that we begin hedging portfolios. And now I think we've got just about everybody we can effectively hedged. And in those smaller accounts where we have grandchildren and that sort of thing, too small to hedge, then we're just cutting equity exposure right now. So again, we're playing it safe. We are absolutely, under present circumstances and what we see under the surface, very willing to not participate like we normally would, like we have ever since 2008 in this kind of up till recently roaring bull market. Now we think it's a time to be defensive, and we're very willing to change our minds. It's based on the data, based on trends and so forth. So right now the technical trends are concerning. These are classic. And when I zoom out to the weekly and monthly charts, folks, this is exactly what we're seeing. So it doesn't mean it has to play out that way, but probabilities aren't looking good. Let me throw three more at you, and then I'll let you go. So earlier this week, I think it was Monday, that was the last video we did. And by the way, thanks for all the feedback. I appreciate those of you who are enjoying these videos. The feedback, I'll try to do them more often. We've had a lot going on the last couple of weeks, and we're just kind of modeling what we're going to look at next year in terms of staying, protected to the downside, and how we're going to squeeze out some gains as well. So we're looking at different scenarios and so on. So that's taking up a lot of our morning time when I might be shooting a video. But I'll get back to doing them a little more often. But on Monday, I showed you this VIX indicator that I guess I kind of created myself. The VIX curve is something that's part of our financial market sub-index that we score each week. And what I've noticed is that when the 1 month in the spot, the green is the spot VIX. It's the price of implied volatility on virtually at the money S&P 500 index options. The yellow is the 1 month future, and then we've got the 2, 3, 4, 5, and 6 month futures. I'm looking for gaps between the spot and the out months, and it could be the 1 month and the spot. Now, as we get close to that 1 month expiration, these two are going to come together. But notice what I've noticed in here, and that is that when we start seeing this gap widen, we tend to see the market, top. Not necessarily every time, but I did begin to notice this pattern when essentially what it says is that options and traders and market makers a few months out are expecting substantially more volatility than they are currently. And you can see right when those gaps were forming, the market was getting really dicey, and you can see it began up in here, had a little bit of a move here, had a much bigger correction in here. You can see it market beginning to dip, a little bit here, and then another noticeable correction right in here off of this one. Back in here, we had we had the market getting really choppy, toppy, if you will. Big gap in there, and then we had that monster, 20% decline October, November, December last year. Notice some widening here, bit of a corrective phase there. Back in here, it's kind of weird looking. This is really something I've been noticing more the last year and a half or so. There was some widening here. It was very uniform. We did see this gap, and we did get that that 10% plus correction back here in the early 2008. So anyway, this is how it looks today. So recent history would suggest, look for something to the downside. And, what I'm concerned about is if we can get something to the downside that morphs into something bigger on the downside, well, then, of course, that could have an impact on consumer sentiment. And as I continue to say, it is the consumer that's been holding up this economy. So that needs to continue for this expansion to continue, of course. Also, earlier this week, I showed you this look at volume. S&P 500 daily chart. What I was noticing is that daily volume, this is the 10-day moving average, that when that 10-day moving average dropped below this 500 million share line, you can see, we see where I've circled this, it seems to happen near, choppy periods or toppy periods. Here, as the market was topping back in September and October of last year, you can see volume 10-day moving average dropped below my line there, created some space, and I'm looking for space, and sure enough, the market began to top. Here, as the market was coming down, you notice volume was staying pretty steadily up there as the market was rising, and here everything looked okay until it didn't. We dipped below there, followed by a correction, pretty good correction, biggest one this year so far. A little bit of a dip right there, just a little bit of a sell-off kind of to go with it. Much bigger dip right here, notably bigger sell-off up in here. I really, as you recall, expected something considerably worse, and we didn't ultimately get it down in here. Trade war rhetoric and so on kind of brought us out of that, and threatened it once again, and then we've come out of it, and again, here we are at marginal new highs. But notice just not quite, nothing to really, talk about in here, but it was coincident with that. But here we have something that looks definitely more definite, if you will, and that is we have this noticeable, space underneath. We have a marginal new high, and again, we'll see if this plays out as it has pretty consistently over the last couple of years, and that would suggest that we have something along the lines of a, mid to high single-digit sell-off at the minimum, based on this. And what does this mean? This simply means that you aren't getting any conviction on these big rallies. That when you have a move in the market, you want to see high volume, to substantiate it, meaning, yeah, are we really getting a lot of good buying in here? Are we getting a lot of volume, a lot of action? Is the smart money coming to rush in? Or are they distributing on these rallies? Right now, frankly, the volume looks like they're distributing. They're taking the opportunity, perhaps retail investors rushing in, and for the, air quotes, smart money to sell out. Notice this. This is yesterday's volume. Yesterday was a down day, and notice that was the biggest volume day we've had in several weeks, and it came on a pretty good red candle yesterday. So again, more conviction on behalf of the bears versus the bulls. Get a nice rally this morning, though, on that jobs number. So I'll update you on this in the not too distant future. Okay, lastly, short interest on SPY, which is the tracking index for the S&P 500, tracking ETF, I should say, for the S&P 500 index. I showed this to you first right here when short interest was at, I believe, a multi-year high. And remember, shorting is selling borrowed shares that you have to replace, expecting to replace them at a lower price. So you sell them, you borrow them, you sell them, then you buy them at a lower price, and you pocket the difference when you return the shares to their rightful owners. So I was showing you down here on this December 24th low, exceedingly high short interest, and I was basically saying that a lot of people are betting that this is going to go a lot further down. But what I was suggesting in here, we get just a hint of good news. These shorts are going to cover, because remember, they have to buy those shares back and replace them. And if the market goes up, they could get utterly killed because they end up buying them at a higher price than where they sold them. So short covering is something that you see, and a lot of times it explains when we break through a certain level why the market just suddenly boosted higher. Well, this was easy. This was an easy call to make from here, and sure enough, that's exactly how it played out. We had a huge rally as these shorts covered. But what I've been noticing is that when the short interest gets very, very low, so there's a lack of that pessimism out there, then you got to look out for the opposite, because if suddenly we get a little bad news and these shorts come in and borrow and then sell a bunch of shares, of course that puts downward pressure on the market. So what I've identified in here are areas where we had short interest come in below this level here. So what happened when we had a substantial bottom and really came up off of that? What did the market do, or how long did it take to top? So here we go back to December of 2017. Very low short interest, bottomed, and 28 days later, we had this top here in January, and we had a 10.16% correction in the market. Back here in August of 18, bottomed, spiked higher. 35 days later, the market topped, and we ended up with a 19.82% correction in the market. Right here, we bottomed again. 15 days later, we topped. Market fell 6.8%, bottomed right here. Right, pretty much simultaneously. It was 2 days before that bottom when the market topped, so shorts are a little behind the ball there, and we had a 6.12% decline. So here we bottomed noticeably, definitely a big enough spike to bring this indicator alive. And we are now, 31 days or so from the bottom, and we still really haven't topped. So this is, pretty strong indication here the last couple of years that we could be seeing some downside risk here, despite today's rally. So, folks, I guess for me to characterize it like I have in the past, remember back up in here I was saying the market feels heavy to me, technically speaking. I'd say that's still a good characterization of what I'm seeing in here. This is really exactly what we've been seeing the last few years, is, a lot of volatility, a marginal new high, and then we kind of roll over. We're getting into that good season of the year. I've been telling clients, I know we're hedged. I know we're not really participating much in this party as it goes higher, a little bit, but not a lot because of the hedge. But could, continue to melt higher. I like what I saw in the jobs number. I think people should be a little less pessimistic based on what we saw here today. I'll say this again, ultimately though, whether it's in the next month, 6 months, year, 2 years, there's that mess underneath the surface in the corporate debt market, and that really has my attention. So you clients out there, we're still going to stay very defensive for the time being. And right now we are looking at various ways to squeeze extra yield into portfolios, but first and foremost, safely. Have a great weekend. Thank you, as always, for watching and listening. Talk to you again soon. Bye-bye.